Verizon Q2 2025 earnings breakdown, strong performance, and raised guidance. Record-breaking results and an ambitious outlook. Verizon isn't just meeting expectations in 2025, it's boldly raising the bar. After a standout second quarter, marked by robust financial and subscriber gains, Verizon has officially upped its full-year forecast for adjusted EBITDA, adjusted EPS, and free cash flow. But here's where it gets even more interesting. The drivers behind this surge go far beyond just numbers on a balance sheet, touching on industry competition, AI innovation, and broadband battles that could reshape the market. Key takeaways from Q2 2025. What's fueling Verizon's momentum? Verizon's wireless service revenue soared to an industry-leading $20.9 billion for the quarter, showcasing not only customer loyalty, but also growing demand for mobile connectivity. The company added a net of over 300,000 new customers between its mobility and broadband services, cementing its role as a preferred provider across the United States. Consumer postpaid phone additions increased both compared to the previous quarter and year-over-year, a sign of rising consumer confidence in Verizon's network and offerings. Verizon continued to capture a larger share of the broadband market by boosting its fixed wireless access and expanding its renowned FiOS fiber-optic service, critical in an era where high-speed internet is no longer a luxury, but a necessity. The company deepened customer relationships by tailoring services with segmented, innovative products like the Best Value Guarantee, My Plan, My Home, My Biz Plan, and a transformed customer service approach. Recognition keeps pouring in. J.D. Power awarded Verizon top honors for wireless network quality for the 35th time, and RootMetrics named it the nation's best, fastest, and most reliable 5G network in the first half of 2025. With these achievements, Verizon's financial foundation grew even sturdier. Chairman and CEO Hans Vestberg highlighted how the company's diverse revenue streams and disciplined strategy drive performance, saying, "Our unmatched and award-winning network, combined with financial strength, lets us constantly innovate, empowering people to work, connect, and play." We're entering the second half with momentum and an even more optimistic outlook. With the pending Frontier acquisition on the horizon, that momentum could soon accelerate further. Diving into the numbers, second quarter 2025 performance. EPS jumped to $1.18 from last year's Q2 figure of $1.09, and adjusted EPS rose from $1.15 to $1.22. Operating revenue increased 5.2%, reaching $34.5 billion. Cash flow from operations for the year's first half totaled $16.8 billion, edging past last year's $16.6 billion. Free cash flow rose to $8.8 billion, up from $8.5 billion a year ago. Net income hit $5.1 billion, while adjusted EBITDA was $12.8 billion, both up year-over-year. Wireless equipment revenue shot up an impressive 25.2% to $6.3 billion. Despite these wins, Verizon's unsecured debt climbed to $119.4 billion, a slight increase from the previous quarter, but still down from $125.3 billion a year ago. The net unsecured debt stands at $116 billion, and key debt ratios remain in manageable territory. Broadband expansion, winning share with speed and flexibility. Verizon delivered 293,000 broadband net additions this quarter alone. Fixed wireless access, a rising alternative to cable, added 278,000 new accounts, swelling the total subscriber base to over 5.1 million. Verizon believes it's on track to reach as many as 9 million fixed wireless customers by 2028. Across all broadband offerings, total connections now exceed 12.9 million, a remarkable 12.2% jump from last year. The FiOS fiber footprint is expanding steadily, targeting 650,000 new homes or businesses in 2025. Consumer business, deepening engagement, and low churn. Consumer segment revenue climbed 6.9% year-over-year, reaching $26.6 billion. Wireless service revenue in the consumer group hit $17.4 billion, up 2.3%. The dreaded metric of postpaid churn, customers leaving the service, stayed low at 1.12%, with postpaid phone churn at just 0.90%, indicating strong customer satisfaction. The average revenue per account also rose 2.3% to $147.50. The decline in wireless retail postpaid phone net losses, down to 51,000 from 109,000 a year prior, suggests retention is improving. Meanwhile, core prepaid products made a strong showing, swinging from net losses last year to 50,000 net additions this quarter. Consumer operating income nudged up 0.5% to $7.6 billion, with EBITDA margin at 42.1%, slightly lower than last year, but still robust. How much margin compression is tolerable before investors get nervous? Let us know in the comments. Business segment. Income surges despite modest revenue decline. While total revenue for Verizon Business ticked down 0.3% to $7.3 billion, business wireless service revenue grew 1.6%. The division reported 65,000 wireless retail postpaid net additions, including 42,000 postpaid phones, testament to solid execution amid challenging enterprise and small business conditions. Postpaid churn in business was a bit higher than consumer, 1.61% overall, 1.26% for phones, but still within industry norms. Business operating income soared 27.6% to $638 million, with EBITDA margins jumping to 22.9% from 21.6% a year ago. Might this uptick signal a turning point for Verizon's enterprise strategy? Updated full-year outlook, cautious optimism, or justified confidence? Strong execution and favorable tax reforms are giving Verizon the confidence to project adjusted EBITDA growth between 2.5% and 3.5%, adjusted EPS growth ranging from 1% to 3.0%, cash flow from operations in the $37 to $39.0 billion range, free cash flow of $19.5 to $20.5 billion, wireless service revenue up by 2.0% to 2.8%, capital expenditures estimated between $17.50 and $18.5 billion. Notably, this guidance does not account for the potential effects of the pending Frontier acquisition, a factor that could reshape the landscape, depending on how integration plays out. Some industry watchers might wonder, are these growth targets reasonable in the face of intensifying competition and an ever-shifting regulatory environment? Recognition and competitive edge. Verizon continues to rack up prestigious industry awards, building its reputation as the go-to for network quality and reliability. J.D. Power recognized Verizon. Verizon boosts annual forecast, premium plans, and tax law benefits drive growth. In a bold move reflecting the strength of its premium offerings and the impact of recent tax reforms, Verizon, a leading U.S. wireless carrier, has raised its annual profit forecast. This adjustment comes as the company experiences robust demand for its top-tier plans and benefits from the Trump administration's tax law, which has been a significant boon to corporate finances. On Monday, Verizon stock surged by 3.5% as the company reported better-than-expected sales and profit figures for the June quarter. A notable 2.2% increase in wireless service revenue played a crucial role in this positive performance. However, the landscape is increasingly competitive, with rivals like AT&T and T-Mobile, along with broadband giants Comcast and Charter, vying for market share. To stay ahead, Verizon has introduced price lock promotions and bundled broadband wireless deals to retain customers. But here's where it gets controversial. Finance chief Tony Skiadas attributes a substantial portion of the company's financial improvement to the U.S. tax reform, which allows for immediate write-offs of new equipment costs. He predicts that this legislation will enhance Verizon's free cash flow by $1.5 billion to $2 billion this year. As a result, Verizon has revised its free cash flow forecast upward to between $19.5 billion and $20.5 billion, from the previous estimate of $17.5 billion to $18.5 billion. Looking further ahead, Verizon now anticipates its 2025 adjusted profit to grow between 1% and 3%, up from the previously projected range of 0% to 3%. According to Wells Fargo analysts, Verizon pays the highest cash taxes among major U.S. telecom companies, making the tax law particularly beneficial for the industry. Despite these positive developments, Verizon faced a setback with a surprising loss of 9,000 monthly bill-paying wireless subscribers in the second quarter, a consequence of price increases implemented in January. Analysts had anticipated an addition of 13,000 subscribers. To combat this challenge and drive future growth, Verizon and its competitors are investing heavily in fiber-optic infrastructure, capitalizing on the surging demand for high-speed data services. In May, Verizon secured approval from the U.S. Telecom regulator for its $20 billion acquisition of fiber-optic internet provider Frontier, following an agreement to terminate its diversity programs. This strategic move has already shown dividends, with Verizon reporting 293,000 broadband net additions in the second quarter. Overall, Verizon's second quarter results were impressive, with revenue reaching $34.5 billion, surpassing the estimated $33.74 billion. Adjusted earnings per share came in at $1.22, exceeding expectations. Shares of AT&T and T-Mobile also saw gains, rising by 2.3%. What do you think about the impact of the tax law on Verizon and the broader telecom industry? Is the increased investment in fiber-optic infrastructure a smart move, or is there a risk of overinvestment? Share your thoughts in the comments below.